Hey, what's up, guys? You got Curtis here with Long Trend. Today we're going to take a look at McDonald's. We're going to go through their most recent investor deck. We're going to open up their 10K and look at a few highlights. Then we're going to open up the Long Trend web model. We're going to look at their revenue, their growth in their margins. Then we're going to take a look at their dividend coverage. And then we're going to decide if we want to buy that stock at today's price. All right, stick with me. So up beside me here, I have McDonald's most recent investor update. So that was dated November 9th, 2020. If I scroll through this, I just want to highlight a couple of things that I thought were interesting. So the first thing is that even though this is November 2020, they only did till 2019. The reason for that is because of COVID. I want to highlight here that they talk about their progress over the last 5 years. So 4.1 to 5.7 billion of free cash flow. That seems to be a theme through this presentation. You can see that system-wide sales have grown for sure, but as we'll get to in a second, there hasn't been a significant amount of growth for the company over a long period of time. Scrolling down, it does look like operating margins have improved, but again, we're going to translate those operating margins to cash and see if the cash has actually improved over time. Last slide in this deck, which I thought was interesting. So one is invest in the business. So they're going to recapitalize their business over time. It makes sense to do that. The second is their commitment to pay the dividend. McDonald's has actually been paying their dividend, and they've been a dividend grower for a long period of time. But unless you're consistently growing revenue and free cash flow along with that dividend, eventually your dividend coverage starts to deteriorate. And then third is pay down debt. So that would be a good idea. They do have a fair amount of debt. Okay, next up, let's fly through the 10K and see if we can pick out a few highlights. So I've got the 10K here for McDonald's open. This is through December 31st, 2020. So the first thing I'm going to look at is I'm going to go to this Outlook section, and then I'm going to pick out a couple of things. The first point is the company expects 2021 system-wide sales growth in the low double digits. It's important to note that this is off of 2019. So 2019, as I'll show you, has been their worst year in a long period of time. So I would expect some double-digit sales growth off of COVID year where a lot of restaurants were closed. Next up is they're expecting a 21 to 23% tax rate. Okay, that's useful for the model. And the other thing that's interesting is the company reports this free cash flow conversion rate greater than 90%. So what they're reporting there is how much of their net income are they converting to free cash flow. So over 90% free cash flow from net income, that's a good thing. That means that what they're reporting as net income is actually being converted to cash. So scrolling down to the revenue segment note, you can see that the company breaks its business into company-operated sales and franchise revenue sales. So overall, revenue did not grow from 2018 to 2019, and it was impacted by COVID in 2020. So we're going to ignore 2020 because it's not representative of a typical year for McDonald's. Down in the selected financial data, there's 40,000 system-wide restaurants, of which 2,700 are company-operated restaurants and 36,000 are franchise restaurants. You can also see here that the company pays a dividend of about $3 billion, so 3.2, 3.5, and they've been growing it. And they've also been buying back stock. So 11 billion, 4 billion. They've been buying back about 5 billion of stock a year, except for in 2020, again, due to COVID. And what I'm going to show you is that actually a significant amount of that stock repurchase program has been financed by debt, which is why earnings per share growth has outclipped net income growth over that period. Okay, and then the last thing that's important to note about McDonald's is that the company owns and leases a lot of real estate, and it's primarily connected, as it says here, with its restaurant businesses. And so what it says here the company does is it identifies and develops sites, and then it goes, buys the land or secures a lease on the land and installs a franchisee to run the business. And then they actually charge the franchisee rent to run the store. So they collect rent and they collect royalties. And actually the rent payments that the company collects are higher than the royalty fees for operating McDonald's for the franchisee. All right, folks, we're at my favorite part here. We're going to look at McDonald's inside the Long Trend web model. This is a web-based tool that I developed that takes Edgar data that I sourced using Python and pulls that data into a web-based model where I can use it to quickly analyze, flex, and ultimately determine an expected return for a particular stock. So starting with enterprise value for McDonald's, this is a $245 stock with 750 million shares outstanding, so market cap of about 183 billion. An enterprise value of $230 billion. So as of trailing 12 months through June, McDonald's was at 20 times enterprise value to EBITDA. That's higher than historically. Over a 10-year period, they're at 15 times. And they're about 2.8 net debt to EBITDA. And that's also increased over time. In 2012, for example, they're at 1.1. I've already plugged in a revenue growth forecast. I've made it flat because McDonald's has not grown their revenue in a long period of time. If I go to charts and I look at McDonald's revenue, 10 years ago, which is last fiscal year minus 9 years, 27 billion, then 28 billion, 25, 24, 21. The revenue's not gone up, it's actually gone down. So it's hard for me to model anything except a flat revenue line. You could put 2% growth in here. Maybe McDonald's grows at the same rate as the economy, but no more than that. Back to the model. Down in the operating assumptions, I'm happy with that revenue forecast, and it's a fairly aggressive EBITDA margin forecast, so we'll leave it at that. The tax rate burden makes sense to me. The current tax rate of 23% is in line with the guidance that we went through in their 10K, and I've actually made capital as a percent of revenue lower than historic. So what that means is they're going to be less capitalized going forward. That pushes their free cash flow higher. Down in the free cash flow section, let's translate, as we mentioned, that operating margin that they discussed into cash. So I can see the last few fiscal years, 18, 19, 20, they did about $5 billion of free cash flow. If I expand that out, they've done about $4 billion and $5 billion of free cash flow for a long, long time. So 2011, 12, 13, 14, so $4 billion, $4 billion, $4 billion, $4 billion, $5 billion, $4 billion, $4 billion, $4 billion, $6 billion, $5 billion. And then going forward, it's about $6 billion flat, because I'm not giving them any revenue growth credit. Down in the sources and uses section, I can see that they've been growing their dividend at an okay clip, so between 8 and 10%. Last year, they did 6.6%. I don't think that they're going to be able to grow it much faster than that, and here's why. So right now, they're going to do $6 billion of free cash flow, and they're going to pay $4 billion. But over time, unless they also grow their top line, what ends up happening is their dividend coverage deteriorates. So we can see they've got $2.6 billion of dividend coverage in the first year, but that actually flips out the curve. So within 10 years, this company's dividend coverage, if they grow in at 6% and they don't grow their top line, actually approaches 1. What's also interesting about McDonald's is their share repurchase history, as we suggested. So they do buy back a lot of stock. But as I mentioned, they've actually had to finance a lot of those repurchases, and they will have to do that going forward if they want to buy back the same level of stock. So what does that mean? That means that the growth in earnings per share, unless they grow top line, is going to decrease because they're not going to be able to cancel as many shares going forward, unless they want to keep levering up their balance sheet. Okay, so to recap, revenue and free cash flow have not grown over the last 10 years. Their dividend growth will likely have to slow going forward unless they can start to grow the business. And unless they keep borrowing to buy back stock, their share repurchase program will likely have to slow down as well. And then on top of that, if I go down to the expected return section, McDonald's isn't exactly a cheap company. So if I work this all out into an expected return, so right now the stock is $245 a share. As a shareholder, I get the dividend of $5.50 that I'm projecting, and that roughly doubles over a 10-year period. And then if they don't grow the business over a 10-year period, they'll still be trading at roughly the same enterprise value to EBITDA, which is not exactly a cheap multiple at 20 times. So I wouldn't be surprised if McDonald's was trading at $250 a share 10 years from now. And that's just my opinion, but that's just what the numbers look like. So if you bought the stock today, you'd get the dividend, but I don't see where the capital appreciation is going to come from unless they can figure out how to grow free cash flow over time. So I think McDonald's is going to be a 3% return company over a 10-year period. Okay, guys, so to sum it all up, I'm not a buyer of McDonald's at these levels. I'm not sure where the growth is going to come from, and I'd like to see some growth before I get interested. I worry that you buy McDonald's and you get the dividend of 2-3%, and that's all you get over a long period of time. So yeah, it's not for me. That's just my opinion, and I just think that there's better opportunities elsewhere for my capital. Hey guys, thanks for watching. Look, they can't all be buys, right? But I do like to take an objective and analytical approach to each evaluation. And if you do enjoy this type of content, please like the video and subscribe to the channel. It'll help me grow the channel so I can keep reviewing more stocks. All right, appreciate it. Okay, bye.